From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello, it's the COB, all the stuff you need to know about the day in business and markets. I'm Kyle Rodder with...
And I'm Daniela Couillet.
There we go. Okay, well, let's have a look at, the market today. CBO 200 was more or less flat. The ASX 200 flat as well. Now, we had plenty of risk events to digest, I suppose from a macro point of view more particularly, and the Wall Street lead was a little bit mixed to say the least. Jamie Dimon putting the banking crisis back into the centre of the conversation. But with all of that said, like we were saying before, Danny, a pretty flat close for the session.
Absolutely. It is very much looking like the market is trying to work out which way should we go at the moment. And clearly there's a lot of uncertainty. We've got a holiday coming up, which always drains volumes out of the market. Gold has been very, very much in focus, and no doubt we'll be chatting with our guest about gold. And you're really seeing the Australian market taking the lead from the US, like the utilities are performing a little bit more strongly today. Still seeing profit taking in the big miners and the lithium stocks. You know, everyone's panicking that they've got too many EVs in China at the moment. But, you know, really, I think it's all going to happen on Friday when the markets close, isn't it, with the non-farm payrolls?
Most definitely. And like you just noted as well, is that we've got 2 days until that happens. You wouldn't blame anyone for perhaps sticking to the sidelines, if you will.
Absolutely.
Before that public holiday when that news is going to drop. A very interesting set of circumstances, which doesn't always occur, obviously. But let's get to some of the corporate news to the day. A few quick reads here. Favour Energy will buy convenience retailer On the Run for $1.15 billion. The deal, which is for a network of 205 convenience retail stores, will see Viva Energy become the biggest non-government employer in South Australia.
Yeah. And gee, the poor old fund managers, they continue to be bashed up, with Magellan has seen FUM continuing to fall, and it has experienced net outflows of 3.9 billion in March. So their total FUM now is down to 43.2 billion from 45.4 at the end of February.
Yeah, it comes off the back of course, that net wealth news during the week too that saw weaker than expected funds under management numbers there too. But core lithium, we can't go without talking about lithium at least today, and it says it sees 3,500 tonne parcel of spodumene concentrate has been trucked to the Darwin port ready for export. It also says full mining operations have resumed at Finniss following safety work. And Danielle, a few broker moves out there today as well.
Absolutely, let's run through these. JP Morgan has raised the target on Xero to 109 from 103 and retains an overweight rating.
Rare earths producer Lynas has been upgraded by UBS to buy from neutral due to the 33% decline in the share price from January, with a target price of $8.90.
And Macquarie upgrades Orica to outperform from neutral. The target is raised to 17 from 16, with earnings upgrades from better price mix and demand recovery.
And SEEK has been upgraded to outperform from neutral. Macquarie sees a risk reward skewed to the upside. The target price has been raised from $32.50 from $23.50. So there's your corporate news of the day. And, well, it's probably a
gold.
Point
Did you see? I'm wearing gold today. I felt the need to come in and shine, because everything that glitters is gold, or is it not?
Absolutely. You're, what do they say, a conformist indicator? You trade with the trend whenever Danielle's wearing gold. But here are the gold miners today, up broadly across the board. Again, those banking fears again are perhaps stoking some concerns about financial stability. Also, we have, I guess, generally speaking, expectations that, well, all but over is the rate hiking cycle in the United States, although that is a reasonable chance. So, let's move on. Stock of the day, we'll talk about it today. And Nadine sat down with a couple of guests to discuss Viva Energy.
They're not issuing any equity, only to the company they're buying on the run. So it looks like the market likes this. They have got a pile of cash and they're using that for this deal, which is good.
It is absolutely, because we're beheld by the Singapore refining station, I guess, so everything has to go through Singapore. So really those refining margins are very lucrative for the refiner, but Ampol or Viva, these guys are the ones that have to sort of take those prices as they come through that refining margin. So potentially, yeah, it's an okay thing. One of the things that I did see in this announcement is that OTR, they are part of the deal getting Smoke Mart, which is and gift box tobacco. So some wholesaler of cigarettes in there as well. I suspect they might divest some of that with ESG being a bit of an issue going forward, so they might sort of digest that. But overall, it looks like a really good deal. I'll stay with the hold as well, just on that price action alone. Potentially, it looks like it's broken out, but I think it potentially could come back and retest those levels, so hold.
Okay, so a double hold there from Henry Jennings and Adam Dawes. But let's talk about your view today, Danielle, because of course folks out there would be well aware that we've got the pen scratching on the desk next to me over the last few weeks, getting a few views out there. What were you discussing today?
Yeah, well, I come from equities, therefore I have to learn about bond markets. That's the way it works, because they're the elephant in the room, and equities people, sometimes they don't want to look at the bond market. So I took a little bit of a deeper dive. I look at what has been happening there, and really there are a few signs starting to come through from the bond market. If you look at their volatility index, the move, it's very elevated. And I wanted to question, why was gold performing? And typically, if we look through history, gold performs when there's an expectation of real interest rates coming down, which two signals: we're either going into a recession or inflation's coming down, or both, or potentially the banking crisis is still knocking around. So maybe we can go to our guest who can shed some light on how he is seeing things at the moment.
Absolutely. So for a person who's had his foot in the bond market and the equity market, no less, Mark Gardner from Macro Capital. Maybe we'll start on that topic of conversation, Mark, because you have had experience in both sides of the world, and it's a topic that's come up a couple of times today with guests. It's just the dynamics we're seeing in equities, pricing in maybe a fairly robust future, maybe a soft landing if you want to call it that, versus the bond market, which is, I guess, signalling something a little bit more dire. How are you interpreting things at the moment?
At the moment, with that move so elevated, normally you would rely on the bond market for a clear picture of what's probably going to happen. Equities do tend to get elevated and get carried away, and then both on the upside and the downside, whereas the bond market tends to be a hell of a lot more stable. That's just not been the case of late. Danielle's absolutely correct. When basically you see peaking in a rate hike cycle, tends to be probably one of the better times to be buying gold. Obviously, there's a lot of fundamentals with gold that really have kind of fallen apart. And we had central bank buying last year, and it really went nowhere. Obviously, with this uncertainty that's come back into the banking sector, and a return to almost printing money again, or making money more freely available from the Fed in extraordinary measures, trying to stabilise the banking sector. Obviously, people, even crypto, started to go up. Look, they are very similar in characteristics. They're not very, they're both not used in an industrial sense, and they're a store of value. So. I sometimes regard, anyone who's done their economics degree before the 90s probably favours gold, and then probably someone, after that maybe favours the digital currency. But all it is the fiat currency system's a trust system. They can't print money forever, and that's where you'll start to see, obviously, things that they regard as a store of value start to elevate in price. So obviously we're at key levels in gold at the moment at 2,000. I prefer to go with a mix of something, say, Evolution's got quite a decent amount of new copper discoveries. Silver is pretty similar, or platinum with palladium. They tend to rally, not quite as hard as gold because it's a bit more of a thematic trade, but the rallies will tend to be a bit more sustainable, particularly with with a higher level of industrial use. So I try to find something with a bit of a mix. You know, the silver stocks have done extraordinarily well with the rally in gold recently. I think silver's outpaced, you know, by almost double. So, you know, there's not a huge amount of silver miners in Australia, and a lot of them are early stages or exploration stages. So there's not much to choose from, but yeah, and quite a lot of them, because of that reason, have kicked up pretty hard. So they're probably not valued necessarily at these levels. But yeah, I think it's a bit of a shock from the RBNZ today, going 50 instead of 25. Which kind of really took the optimism out of the Aussie market. I think you know, we've sort of stepped back because of, I'm assuming, because of the housing market and public pressure and things on the RBA. But you know, New Zealand's also seen 23% decline in house prices, the biggest one-year drop, well, in history, I think, or at least in multi-decade. So, you know, some central banks are still not fearing, you know, crushing that asset price a little. So yeah, I mean, there's so much up in the air at the moment. I think sitting particularly with a 4-day weekend, payrolls coming out, and then the next session's going to be a very thin, you know, public holiday session in futures in the US on a Monday. Yeah, it's certainly taking profit. We've had a nice little bounce in the last week and a half, from about 6,900 back up to what, 72.70 or thereabouts. So. And look, the only thing that's held that back from probably going another 100 points is the iron ore price has dropped. So yeah, I think leading into that 4-day weekend, US earnings season coming up. I think it starts on the 14th with the banks. Yeah, probably not a bad time to be taking a little bit of risk off the table.
What's interesting is watching this Australian dollar, which is actually falling quite a lot post Lowe's talk, which was interesting because he was at pains to stress we may not have, you know, finished raising rates, and yet the Aussie dollar has gone completely risk off. Given that sort of, you know, as you said, it's a balancing act at the moment, how are you positioning your portfolios going into the month of April before we get to the dreaded potentially sell in May and go away?
I've sort of started taking up a small hedge position in ETF called SNAS, short NASDAQ. The average PEs have gotten back up to sort of somewhere around the mid-20s or early to mid-20s again, which is getting a little bit high for, you know, given what's transpired over the last couple of months. They do have those earnings coming up. A lot of those big tech companies have cut a lot of jobs. I think Google even put a freeze on anyone, you know, buying new equipment and things like that. So I can't imagine these results, whilst the backward-looking results might be okay, the forward-looking results probably aren't. They're not going to sack 30,000 people and then go, it's all fantastic. So probably not expecting that to go so well, particularly as well with the banks. You know, that reporting is going to be watched pretty closely as well. So, but in mainly some defensive stuff, in some bond ETFs. There's been a new one launched this week, US investment grade bonds from Global X ETFs, which sort of tracks an existing iTrax product. So sort of corporate grade bonds there. I'm getting pretty decent yields overall, and yeah, and about probably 10 to 15% cash minimum, I think, at the moment. Because if we do fall back, fair enough. You know, at least you can look at it glass half full, and you can take advantage of some buying opportunities. I don't think we're going to miss too much being in cash, you know, if we rally from here, because we've had a fairly significant rally in that NASDAQ over 1 month. If you look at the two charts, March last year versus March this year, they're eerily similar. And you know, I'm certainly not expecting the fallout we had in the NASDAQ last year, down 18%. But I think I think it could probably potentially give back half of that, you know, half of those gains. And yeah, but there's a lot still up in the air. Bond yields and equities dropped last night, which is sort of gives the impression that we're more worried about the future health of the economy rather than you know, the terminal rate anymore. So yeah, but it's still very much wait and see. It would be short list of high quality stocks for now, and dare I say, some of those stores of value.
Absolutely. Just with the market reaction to the RBA as well, and maybe even how you're trying to react to it with what you just mentioned. I mean, there seems to be a large element of just the market not listening very much. You know, we've got basically rate cuts being priced in at the margins, no less, even despite this rhetoric of, well, we're not necessarily done. Is there an element here where, you know, they're just not credible enough to listen to or believe when they say that, or what are the markets doing? Because it's just, like Danny said with the Aussie dollar, it just seems to be just not listening.
Well, I mean, central banks are generally on the same page globally. I think markets are extraordinarily mixed, and that's where, when there's no clear signals, that's where, that's a situation where, as I said, we've got a bit of bonds and some cash, and we'll take that, we'll take that yield and sit on the sidelines, because, you don't have to invest if there's not a clear picture, and the picture's extraordinarily foggy at the moment. So it'd be a little bit of a wait and see attitude, obviously, and yeah, we will get through these earnings and start to see, because we've started to see the economic numbers turn. We've got services PMI tonight, which probably it's one that's been stubbornly strong, still expanding, expected at 55 tonight, so, or 54.5. That's where that wage inflation is. That if that doesn't start to pull back, I think we get the worst case scenario sort of for the equities, where the Fed may have to hike despite the fact that things are starting to slow down a little. So but we just need more data, realistically. We can't, no one's got a crystal ball, and the central banks don't have the answers, even, at this stage. So I think it's almost, we shouldn't really have an expectation that they do, because obviously they were going back to normalising policy in 2019, late 2019, COVID hit, fiscal and monetary stimulus on a massive scale, and then everything recovered so fast. I think it's probably fair to give them, a little bit of leeway to try and manage this, because they had a whole range of things that they've never had to deal with before, and now they're having to unwind that. So that's where that sort of uncertainty and waiting on the sidelines is coming from.
Just in terms of a possible sector, I'd be interested to get your view on healthcare. Because what was very much, we've seen markets rotate. So energy was big last year up until recently. Energy not big. Technology, big tech, back again. Healthcare, defensive, potentially stable earnings streams. Certainly in Australia, our healthcare stocks really trading ranges but not doing anything. A bit the same in the US. Is that a sector that, if you had to be invested, you'd say that that's possibly might be a good place for people to hide out in?
Absolutely, yeah. I think a big favourite, CSL. They expanded their blood plasma capacity by 30% over the last sort of year or so. The Vifor acquisition's going extraordinarily well, and it's already contributing to the bottom line. I would expect if household budgets start to get tight as well, those plasma donations are going to go through the roof, and they have the capacity now to take that on as well. So I actually see CSL was a pretty decent buying opportunity. I think Morgan Stanley upgraded that today. We've also seen, I think Ramsay and Sonic Healthcare have rallied quite a bit in the last couple of months, probably a good sort of 10%, but from pretty sort of horrible lows. But I think that M&A activity in that sector at the moment's really, brought to the attention of the analysts that things are potentially pretty undervalued. So and I quite like consumer staples at the moment as well. We've got things like Elders, things like GrainCorp, things like Incitec Pivot that are trading at very close to 52-week lows. But GrainCorp particularly has had quite a good win with they own 8.5% of UMG, which has obviously had a really good rally. That's they've made quite good money out of that. And from all reports from people I speak to in the country, and from the GrainCorp outlook, there's going to be a fairly good crop coming up. Wow. So look, there's still opportunities there, and those agricultural companies particularly report out of cycle,
haven't they?
They've been absolutely smashed.
I was just looking. I had no idea they'd fallen as much as they had.
So and on the back of fairly good news, I think Elders will probably solve its problem when it finally hires a successor. And then obviously, but they have off-cycle reporting, so that'll be in May or mid-May, I would expect, because they want to get the results from the summer crops. So I would expect the GrainCorp's result to be extraordinarily good, and it's an ex-government department or company, and it's got fantastic supply chains. They had reports of bottlenecking, I think about 3 months ago, but that was just due to the sheer volume of grain that we're getting in. So that's not a bottleneck that's a problem. That's a bottleneck that's not a bad thing. So I think they were just being honest with the market, and analysts have seen bottleneck and sold. So I mean, they've got high inventories of, they do oil and grain oil and things like that as well, which Ukraine was a massive producer of. There was shortages of oil, vegetable oil through Europe, and that situation hasn't been solved. So I think you'll find that once they come through and report their numbers, that this sort of period is probably offering really good value.
Mark, fantastic to talk as always. I hope you enjoy the long week. And Mark Gardner there from Macro Capital.
Cheers.
Okay, well, let's just recap very quickly just the three themes that we did have in focus today. RBNZ surprise, of course, hiked interest rates by 50 basis points. The consensus estimate was for 25, and some interesting dynamics there. As we were just talking about, Danielle, market shrugged off the low speech. We'll have to see, obviously, the data from here, because as we keep getting told, the RBA is very data dependent. And like yourself, Danielle, gold shined again today. So some of the things that we're really following. But let's move to what we're looking at tonight, because, well, some important data, it has to be said.
Absolutely. So we have the US ADP employment data and the ISM services PMI. So as per usual, everyone's going to be data watching, and markets will be, moving on a dime, so to speak. But really, the big data will be out on Friday. I think the jobs report.
Yeah, exactly. And we're all tucking into our maybe pre-Easter eggs if you're that way inclined. But tomorrow now, RBA financial stability review. Not often makes the headlines, but hey, we'll talk about it. It's something that's a little bit more relevant perhaps over the last couple of weeks because of what's happened in the United States government. Although, as every policymaker would in this set of circumstances, talking up the strength of our banks locally. We're different down here. Of course, those big, strong four pillars that hold us all up. And Danielle, we're going to go to the leaders for the session. Let's get them up now because, well, we were talking before. A lot of gold on your screen.
Absolutely, a lot of gold. Interesting that we're seeing a rally there in SEEK post their investor update that they had yesterday. Clearly, the analysts are looking through that short-term downgrade in revenues to look ahead. Core lithium, I think that was an upgrade, wasn't it? I read that one. So. Interestingly enough, I was reading in the FT that they're actually thinking that you could see more M&A activity in the gold sector. So apart from the firmer prices overnight, you never know, there might be some people taking some positions there on that.
Yeah, definitely. And well, I suppose if you do look across the broader sectoral map too, just as we have some of the individual names there as well. We were talking a little earlier just about utilities actually doing reasonably well. Now, it's a flat day for the market overall, but telco, healthcare, utilities have edged higher too. Some of those defensive names have come through as being, well, perhaps sources of relative stability for investors.
Yeah, market very much positioning for lower interest rates. You saw it in the US, you're seeing it here. I actually thought AGL Energy was quite interesting. Brookfield selling out overnight. They got a premium on their stake that they sold. Share price is up today. Given what's happening in the energy sector and what's happened with Origin, it'll be interesting to see whether AGL stays out of play, so to speak. But I think some brokers are currently liking that stock. But very, very defensive. But let's move to the laggards now. Have a look at those. Yeah, poor old Linus. Can't catch a trick at the moment, can it? It's a bit like Magellan. Magellan really is in a world of pain.
Yeah, it's a bit of a micro and macro hit there, isn't it? Right?
Absolutely.
I mean, funds under management, naturally you would expect a decline if things are getting a little bit bearish out there. Everyone in the investment industry starts to feel that. But, well, there's that key man risk, and it was key man, not to be awfully gendered there, but with Hamish Douglas departing, all of the knock-on effects from that. And just confidence hasn't been restored to Magellan ever since. So not only is that story an equity market story, but it's also just a huge loss of faith. And what was once really just an all-star
Absolutely.
from so many points of view.
Absolutely. I heard this morning that Regal have actually captured a high net wealth client with about 200 million, and one starts to question whether or not they sort of took that. This is, just me speculating, there's no fact to it. But when you have that crisis of confidence in a fund manager, it's really hard to restore it again. And clearly Regal are doing a lot that is working for investors at the moment, and once you're on that roll, then you tend to attract the money. But it will be interesting to see whether we do see M&A starting to come in to the fund management space, or whether or not people are just going to sit back and watch the funds hopefully not slip away forever.
Yeah, well, definitely. And I mean, we were talking about just the different investment environment and different investment world we're in now compared to, say, before the pandemic and the 10 years before it, where, well, everything just went up.
Yeah.
Fund managers have to earn their fees now, and any kind of sign of a crisis of confidence, you're going to get punished, I would dare say. But also, just worth noting yesterday too, is today I should say too, is Whitehaven Coal, but that was after yesterday's big rally. So swings and roundabouts there. Here are some of the smalls now. I don't know if there's anything that jumps out on you that you've got in your portfolio by any chance, because none of them sit in mine.
I don't typically go to small caps.
No.
I find them a bit like the proverbial lobster pot. Well, I think I was chatting about Red 5 earlier, wasn't I? Wasn't that company that rallied when we were looking?
As much as 47%.
Yeah,
I
I
think
think it might have been a software stock that had won a contract over in Miami. But I have to say the other ones are passing me by, except it looks like we have a silver stock there.
Yeah. And we'll get to the laggards there in the small cap space too. Just running very quickly over them. Of course, you always see big moves in this area of the market. So take it all in. There it is. But a fairly reasonable day. Let's have a look actually just at the small ordinaries, just for the matter of interest, if I may. Small ordinaries, so it was actually up today, if I'm not mistaken, up by 0.5%. So there you go, buy your small caps in this market, people. General advice only. But that sort of does it for us today, Danielle. It was great to have you on the hot seat.
Thank you.
Always.
Lots of fun.
Yeah. So remember, everyone, you can catch up on all the news and views and the fantastic interviews that we did have today on your website and app. Otherwise, we'll see you tomorrow morning. Have a great evening.
Have a great night.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.